So what about mortgage rates? So I know we're going to talk about mortgage rates. So we're starting to see the repercussions in Main Street.
Yeah, well, of course. I mean, you see it.
Yeah.
Deals can't get done. People have to lower the price or create some other form of concession.
We're seeing mortgage companies and title companies all laying off, and we own some office buildings, and they're moving to smaller spaces, and the all the things that the transactions are starting to hit. They're starting to flow through.
Well, rates in anything are the price of money.
Yep.
And so if the price of capital goes up, then cap rates to service that debt have to go up. There's just no other way around it.
And that's what we're seeing.
Yeah.
As you know, we probably look at 6 or 8 deals a week. And, when I say that, probably more than that, but those are the ones that actually make it to
The ones that make it through the filtration process
Yeah,
to your desk. They look at 10,000 deals, so Kenny can look at 6.
Yeah, Ross and I are. And it's funny, it's interesting. The last couple of weeks have been actually even quite thin because there's a bit of seller denial going on.
Yeah. Well, I mean, whether you're in the apartment space, just on Main Street real estate, sellers, think because the house peaked at whatever a year ago, that somehow that's what it's worth now. And they're finding out, no, not so much. It literally takes twice as much cash flow to service a mortgage as it did a year ago. That just chops a lot of buyers out of the It's officially a buyer's market in a lot of markets right now.
Because rent hasn't gone up by 2.
Yeah. And then that's a whole different issue. The thing with interest rates, it creates a couple of different problems. The first and obvious problem is the cost of capital, meaning cap rates have to come down, meaning asset values go down. And so you've got that. But the bigger issue is rising interest rates create trauma in the bond market. We've talked about this many times. It's a little heady, but if you understand the inverse relationship between cap rates and apartment prices, then you understand the inverse relationship between bond yields or interest rates and bond prices. And when you have bond yields or interest rates going up, that means bond values are dropping. And so if you can imagine people that have bought bonds when rates were low and levered them up in their portfolio to magnify that thin gain,
and now they're down.
Now they're falling, except that unlike real estate, where we don't get a margin call if our equity erodes, in those, when their equity erodes, they get margin calls. And so you're seeing a bit of a liquidity crisis. People need dollars desperately right now. And part of that is the trauma in the credit markets. So if interest rates continue, it's one level of pain to have to pay higher mortgage rates. It's another if mortgages aren't even available. I mean, back in 2008, almost the entire independent mortgage community just went away, and the only thing left was agency money.
Yep.
So that could happen again too. And I think investors just need to be prepared for that. Watch for the signs of distress in credit markets.
Where do you think rates are going? Where do you think, the Main Street's heading?
Well, Main Street is going to have a hard go of it if they don't understand how to invest. And when I think of Main Street, I think of consumers, your tenants, right? They don't have a lot of capital to invest. They don't have a lot of financial education. They're going to be victimized because the components of cost for everything they need are up. Taxes are up. In October of 2022, we had record tax receipts. Now, that's money that entrepreneurs like you end up having to pay. Of course, you don't pay, but people who aren't in the real estate business, they end up having to pay. And they can't make investments in capital. They can't hire people. They can't give raises, so that is a problem. Energy costs are up because of energy policy. And, you may agree with the policy. You may be concerned about the climate and the things that are driving energy policy. But there's a difference between policies and politics, right? Politics to me is, what would you prefer? If you were king of the universe, what would you want? What do you think they should do? That's politics. We can argue about those things. Policies are what they actually do. And it doesn't matter how you feel about it. Doesn't matter if you like it, you don't like it. They're not really asking you except for your vote. The policies are what the policies are. So we've got energy policy, which drives up the cost of energy. We've got tax policy that's sucking capital out of Main Street. You've got regulatory policy. Previous administration told the bureaucrats, hey, if you want to put in a regulation, you got to revoke 2. And you slowly began to see the decrease of regulatory burden on Main Street, small businesses. Today, it's the opposite. So when you look at all these components of cost, plus inflation on commodities with the disruption in the supply chain, If they don't increase production to bring costs down, then what they're doing is they're trying to crush demand. And that's what this, because you say, why would the Fed want to get rid of jobs? Like, that seems bad. Well, they're trying to destroy demand. They're trying to destroy the consumer's ability to purchase things. And if you think about how cruel that is on a human level, the answer isn't to destroy demand. The answer is to increase production. But the policies we have today don't do that. And so we're going to be suffering a little bit until somebody comes along and changes some of those policies and opens it up a little bit.
The other thing is, real estate is inflationary, or it's been. So it's a big target for inflation.
Yeah.
Or reduction of, I should say.
Well, real estate is the beneficiary of easy money because you've got the jump house of the credit markets pumping air in. And when everything deflated unexpectedly in 2008, the Fed hit the panic button, of course, reflated the stock market, reflated the real estate market, and guys like you that understood what was happening were able to move in when the getting was good, took whatever financing was available, and then when the equity came back and the rates went down, it's like, let's refinance these things. And, the whole infinite return.
Yeah, I know.
Like, hey, it's a harder game to play today.
It is a harder game to play.